Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.isc.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So here's an example of a chart that shows these different stages here. For instance, the recession stage, which is at the very top here, you'll notice that monetary indicators will say that short-term interest rates should be falling, long-term rates also falling. The Federal Reserve begins easing, which of course everybody knows the entire world is doing at this point in time. Our yield curve is steepening as our short-term rates start to fall. Your economic indicators, we have the leading economic indicators down. We have corporate profits pointing way down. We have inflation being less of a worry to the Fed. We have manufacturing contracting and unemployment rising. And ladies and gentlemen, I'm sure you know and you've heard that every one of these things here is truly happening right now. Okay? The sentiment is negative. We have economic news negative, consumer confidence falling. We also have financial advisors strongly suggesting putting your money in safe assets. You see money flowing out of stocks and into bonds for safety purposes, part of the reason the dollar's rallying, of course, and you see stock prices fall going into the recession, but around the end of the recession they begin to rise. So this is the stage we're currently in, and a lot of the world economies, including Japan, was officially in recession yesterday, so they're in the same kind of situation that we are. As you can see on the rest of the slide here, though, eventually we'll have an early recovery, we'll have a mid-cycle increasing growth, and eventually, again, the cycle will complete. We'll have a late cycle with decreasing growth, probably some point down the line. Okay? So it's kind of important that you understand that not only does the economy have this cycle, but the stock market, the bond market, the currency markets, every market you're trading has the same thing too. So when you compare that with what we call the four stages of the market, we have an accumulation phase, we have an uptrend period, we have a stage 3 top or distribution phase, followed by a stage 4 or decline. And stage 1 and stage 3 are both called trading ranges. We have support at the bottom of the trading range and we find resistance at the top. And of course, I've shown this picture before, and I want to mention it again. You'll notice on this dollar versus the Swiss franc chart, which happens to be a monthly chart, we had a similar cycle back in 1995 that lasted all the way through 2008. And as you can see, we had a stage 1 where prices traded in a trading range after a pretty big sell-off, followed by a nice stage 2 uptrend. Up here we have a stage 3 topping process, and after a period of topping out, we actually had another stage 4 decline, which earlier this year actually led to an even lower leg down. Now, this information here is something that a gentleman named Stan Weinstein, he actually wrote a book about these cycles in the the late part of the 80s. Right after the crash of '87, he wrote a book called Secrets for Profiting in Bull and Bear Markets. And this is where I have been able to save myself a lot of heartache by being on the right side of the stages of the market and therefore being on the right side of the various trends. Because obviously, after a stage 1 breakout into a stage 2, you're looking for opportunities to buy dips in an uptrend. And once you break out of that stage 3 top, you look for opportunities to actually short rallies in a downtrend. But as you all know, eventually, just like the cycles of the economy, this cycle is going to actually repeat, and eventually we'll have a new stage 1, etc. And for anybody that's been doing this series with me, you pretty much know that after a long period of decline, which was a stage 4, we have markets moving back into balance. This happened in July earlier this year. The sellers from the higher prices are replaced by buyers who are willing to accumulate positions and they're not really worried about how much money they're making. If these buyers happen to be large institutions, this accumulation can and will go on for long periods of time because they want to try to buy without forcing prices higher. So using these high time frame charts like I do, weekly charts and monthly charts, is the best place to spot this kind of accumulation pattern. And once you get buyers to have bought and sellers to have sold at this price level to where there's no more supply available, this is where a new stage 2 uptrend begins. The stage 3 top occurs after a big uptrend, and after a long period of rising prices, we have another trading range. This trading range now has the potential to become a top. Everybody that accumulated at lower prices are looking to sell to people at higher prices. And so the news during this period of time is going to be good, and it's going to be institutions looking to unload their positions from lower levels. So they're trying to excite the people and the public into buying at these higher prices. That would be where you hear somebody on the TV say, well, we're going to have a super spike in oil at 150. It's going to go to 200 plus. And I believe that was Goldman Sachs who actually came out with that recommendation. Or you're going to have, for example, in the gold market, oh, we're at 1,000. Gold's going to go to 2,000. Or I've heard people when Google was 750 upgrading it to 1,000, et cetera, et cetera. It's always the same thing, folks. It's everybody getting the public excited to buy, and usually the public is wrong and they buy at the wrong time, right at the top. Okay. So bullish sentiment, of course, stage 2 uptrend is markets where prices are rising, and the feeling or the tone of the market, the crowd psychology is very positive. You have buyers willing to pay higher and higher prices, and bull markets are really characterized by periods of optimism where investor confidence and expectations that the strong results will continue. So that pretty much describes a stage 2 uptrend. Bearish sentiment, of course, is just the opposite, like what we're having right now. Everybody's very, very fearful. The market's falling. The crowd sentiment is negative. Sellers are willing to accept lower and lower prices. And bear markets are characterized by this widespread type of pessimism causing the negative sentiment to be self-sustaining, and that is the characteristics of a classical stage 4 decline, which is what we're currently going through right now in our equity markets. Let's update everybody on the state of the dollar. In September, when I was going to do this last seminar, I wanted to mention that the dollar sentiment had turned decidedly bullish with huge momentum. And the U.S. was the first to slow down, and at that point I said that we should be the first to emerge from the financial crisis. But if you look at the long-term charts going way, way back to 2002, the beginning of the actual downtrend, there's still a possibility that this could be just a bear market rally for the U.S. dollar. And it already made a substantial move in September. So traders who had entered the trend at lower prices were now already thinking about how are they going to protect their gains. In November now, we have the dollar's large move has been against all of the major currencies except for the Japanese yen. And again, that's due to the unwinding of the yen carry trade where we were shorting the low-yielding yen, and everybody's being forced to cover. So that's why the dollar is even struggling against the Japanese yen. I heard just today that 350 hedge funds early this morning were out of business, and that I believe was just in London. And of course, we're going to see slides here in a minute where we've just had massive selling. A couple of hedge funds I heard this morning that had $5 or $6 billion positions in the market a month ago were down to several hundred million. So there's a lot of fundamental factors, including our credit crisis, spreading all over the economies of the world. Interest rates being slashed dramatically. But even though we are yielding a whopping 1% on the Fed funds right now, the dollar is still considered to be the world's reserve currency, and with all this turmoil, it's a safe haven currency.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.